Good morning, everybody. Welcome to July's South Carolina, What's Disrupting South Carolina Agriculture, which is hosted every third Wednesday of the month by the South Carolina Clemson Agribusiness team. My name is Scott Mickey. I'm an extension associate based at Sandhill Research and Education Center in Columbia. I've worked primarily in the areas of risk management, commodity marketing, and financial analysis with farmers. What I wanted to do today for today's topic is just kind of talk about some things that are disrupting commodity prices and the outlook for the crops that we grow here in South Carolina, particularly the row crops. I'm going to switch my presentation, and we're going to jump into looking at South Carolina row crop economics. Let's see. Okay. If somebody could just make sure, let's see, I need to share my screen. And once I share my screen, somebody can just confirm that they're seeing my screen. Okay, it should be shared and should say South Carolina Disruptors, July 19th. Okay. So what we're going to start off with is just want to give you a little overview of what I want to talk about. I want to talk a little bit about weather, interest rates, crop insurance, and exports. And then once I've talked a little bit about each of those four areas, we're going to look at some futures charts and also some supply and demand information on several of these crops. So if you have questions, if you would just put them in the chat, and I'll try to take them when I see them pop up. But feel free to ask questions at any time, and we'll try to make sure we've got time to answer any questions that you have. So as you can imagine, weather plays a big factor in disrupting agriculture, not only in South Carolina, but across the country. And every week, USDA puts out a report called the USDA Crop Progress Report. And it comes out usually on Monday afternoons around 4 o'clock. The report itself is probably 30 to 40 pages. And what I usually do is just provide a little summary of some of the information I think is important for South Carolina producers. So what I'm showing on the screen now is that summary from this Monday's report. And as you look at the top, I have several different metrics that we're looking at. And primarily they're dealing with the stages of crop growth. And then going across, you can see that we can see what that metric was on July 16th, 2022, or last year, what it was last week, which was July 9th, and then what it is for the current week of July 16th, 2023. The last column there is showing you what the 5-year average for that metric has been at this point of the year, okay? So the report that we're looking at today, what they were highlighting is the corn silking across the United States. And as you can see that last year, 34% of the crop was silking on July 16th. This year, 47% of the US corn crop is silking on July 16th, which is slightly above average and more than double the amount of corn silking on July 9th. So when I look at that, the first thing that comes to mind is that this crop is progressing a little faster than average, okay? And so you want to keep in mind if the crop's moving faster, rainfall and temperature is more important right now than on average because we're at that silking stage and half of the crop is silking right now. If you look at soybeans, you see something similar. The number of beans blooming is 56% this week compared to an average of 51 and only 46% last year at this time. Cotton is a little bit different. You can see that the cotton that is squaring is a little behind the 5-year average at 64. Last year, or the 5-year average is 69, and last year is all the way up to 72%. So we can say right now, well, corn and soybeans in the US are a little ahead of schedule, a little ahead of average, and cotton is a little behind average. When we look at peanuts pegging, see that behind last year, a little below the 5-year average, but we're not too far off at 69% versus 71. And then when you think about the winter wheat that's been harvested, while all of ours has pretty much been harvested in South Carolina, in other parts of the country, we're only about 56% finished harvesting winter wheat. And normally we're about 70%. So that gives you an idea of where the crop is in the US, how it's growing, how it's coming along compared to the past. The other information that's in this report is the crop condition. And this is just an average assessment of how the crop is faring. They have several categories. It's very poor, poor, fair, good, and excellent. And what I usually try to follow is the total percentage of the good and excellent category. So last year, 64% of the corn was rated good or excellent on July 16th. This year, it's only 57%. And as a result of this crop not being quite as in quite as good a shape as last year's crop, that's why we've seen so much volatility in the corn market since the middle of June. This crop condition has just been all over the place. In fact, conditions improved this week compared to the week before, when only 55% of the crop was rated good or excellent. When we look at soybeans, we see something similar compared to last year. Not as much as in the good and excellent category, although it improved this week compared to the prior week. Cotton, that crop has deteriorated since last week, although it's still in better shape than the cotton crop in 2022. Peanuts are pretty consistent, very comparable to where we were last year, a little bit of improvement from last week, but by far has the highest percentage of good or excellent conditions of any of the crops we're looking at today. The winter wheat crop is no longer reported for crop conditions, but we do have spring wheat, which would be grown in the Midwest and Kansas and places like in Minnesota, places like that. You can see that crop is not as in good a shape as last year's crop was at this time. So when we're looking at that, we start thinking about, well, why is that? What's changing? Why are the conditions not as good? And so I always include some information about the topsoil. And you can see that in the US, topsoil is considered very short to short on about 38% of the US cropland. It's adequate on just over half of it. Comparing that to South Carolina, you can see that we're only short on topsoil moisture in about 11% of the state. And we're adequate on 73, and we have surplus on 16% of the cropland in South Carolina. Topsoil moisture is important, but we also want to look at the subsoil moisture. And across the US, we see similar numbers. About 43% of the subsoil moisture is short or very short, and about half of it is adequate. So this lack of water, particularly in these areas that are short and very short, is causing some of these crop conditions to deteriorate compared to last year. In South Carolina, we have over 3/4 of the cropland is adequate with subsoil moisture, and only 8% is short. So again, this is a good report to take a look at to kind of see what's happening not only in South Carolina, but across the country. If you want to know what soil moisture was in Iowa or Illinois. This report has that information in it. And it's a good way to get a heads up on how the markets may react in the week ahead. The second disruptor I want to talk about is interest rates. For many years, we didn't really worry too much about the interest costs on storing grain. Interest rates were low, and so the cost of holding grain for multiple months was not very expensive. Okay? But now that the Federal Reserve has raised the prime rate, interest rate has really changed the way I look at storage and whether or not you should be selling at harvest or holding on to grain for deferred delivery and payment. So let's just take an example. September corn futures are trading for about $5.25 right now, or they were yesterday. A lot of places are offering 75 cents or so for corn delivered in August and September. And so that would give us a harvest cash price of $6 a bushel. Now, if we wanted to hold that for 1 month and our interest rate was 7%, we would need to get 3.5 cents a bushel more to be as well off a month from now as we would be if we sold it on the day of harvest. Okay. If we were being charged 9% interest, that would be 4.5 cents. And if it's 11%, it'd be 5.5. Okay. And you say, well, what if I'm not borrowing any operating money? Well, that may be, but you still have that opportunity to put those funds to work someplace that doesn't cost. I tend to look at this not only as an interest expense, but it could also be your opportunity cost for not selling earlier. A lot of people like to carry the grain and sell against the December futures contract. So the difference there would be about 3 months of interest. And if your interest rate was 7%, it would cost you 10.5 cents to carry the corn from September through December. Okay? And when you look at the futures board, the futures price only increases to $5.35 and $5.29. So futures price is going up 6 cents. It's going to cost you 10.5 cents in interest to hold it for those 3 months. What would you need to have happen to justify holding on to your corn for those 3 months? But commonly, people may think that basis may improve, and so you may have a better opportunity on basis, and so that could happen. But right now, you need at least a 4-cent improvement in basis just to cover the additional interest cost. That doesn't include any storage costs you may have, such as shrink, the cost of electricity and fuel to keep the corn in good condition. But anyway, that's something that in the last couple of years, we wouldn't have worried too much about because our interest rates were more like 3.5%, maybe 4%. And so we were only looking at, 1 to 2 cents of interest cost per month. But this is something producers need to keep in mind as they move through harvest and look for opportunities to maximize their profitability. If you were to carry corn until March, you can see that in that situation, the futures price goes from $5.29 to $5.45. So it's a 16-cent increase. And at 7% interest, it's going to cost you 21%, 21 cents a bushel in interest costs to hold that grain for 6 months. So it's just something to think about. Look at the opportunities you have to sell at harvest versus what they're going to be for deferred, and make sure you include some interest or opportunity cost in your calculations to make sure that you don't end up with a lower price than expected. The third disruptor, and this is would be crop insurance. And it's not really a disruptor. Crop insurance, we buy it to kind of handle some of the disruptions. But what I like to look at is, what is crop insurance going to do for my crop this year? And as I look at this, these were the base prices we had in South Carolina for crop insurance. So our corn has a price guarantee of $6.09. That would be if you use yield protection or revenue protection. Cotton was at 85 cents. Peanuts, runners were 27 cents a pound, and Virginias were at 30. The soybean price guarantee was $13.69, and our wheat guarantee was $8.40. But where are we today? And so what I want to look at are soybeans, cotton, and corn. If we look at the soybean price, our base price is $13.69. Okay. If I look at the average close of the November soybean contract for the last 22 days, that has averaged $13.44. That's how we calculate the harvest price, is looking back at the last 22 days of futures closes in the month of October. Okay. But what I like to do is just kind of have some idea of where is that harvest price likely to be. And as of yesterday, it would have been $13.44. So we would not have a crop insurance claim based on price, because that's only a 2% drop in price. You would need at least, if you had a 70% policy, we'd also need a 28% yield loss coupled with a 2% price loss just to get to that 70% drop in revenue. If we look at cotton, you were at 85 cents as our base. The last 22 days has averaged 80. So right now we're looking at a 6% price loss in cotton. Corn, we have a 12% price loss. So if a producer were to come in and maybe have a 12 or 15% yield loss this year, it's possible he may have a corn claim on his crop insurance. However, thankfully, most of the corn in South Carolina looks really good this year. In fact, most people are expecting to have better than expected yields. And so therefore, it's unlikely, with only a 12% price drop, that we would see any claims on crop insurance this fall based on what we know today. We know what a hurricane can do to crop yields, and hope they stay out in the Atlantic. But right now, we're not looking at any crop insurance claims from a price change expectation. The fourth disruptor that I want to talk about is this exports. If the U.S. did not export any commodities, we would have huge ending stocks. Okay? Anytime we have huge ending stocks, prices tend to go down. Okay, so it's always important to see what U.S. exports are doing to kind of get a feel for how they may impact our ending stocks. And when you think about exports, what impacts exports besides price is what the international policies are doing. So I give you a little timeline of some things that have happened that may impact exports. In December of 2020, Mexico passed legislation to phase out the use of glyphosate and human engineered corn by January 1st, 2024. That's coming up in less than 6 months. And so if you think about Mexico being very close to a lot of our corn production and a large importer of our exports, this change in the product that they're willing to accept could impact exports. We've known about this for about 3 years. So hopefully we've made the necessary changes. But when you think about what another country does, could severely impact the amount of exports that we can deliver just because of the conditions they've put on their imports. Certainly, we remember last February when Russia invaded Ukraine, the impact that had on commodity prices. There was a lot of uncertainty as to what would happen, how things would play out. Ukraine is a very large corn producer. They export to a lot of corn and wheat to other parts of the world, and so that policy decision by Russia had huge impacts on the market. Very much a disruptor. In fact, that was one of the reasons we started this this series. Was when Russia invaded Ukraine, we decided we need to talk more about how disruptors impact people. In May of 2022, Brazil suspended its import tariffs on corn and wheat flour. That made it easier for people to export to Brazil because the cost of getting it there was now less. That shifted where corn most attractive home might be. So that policy change had an impact. And then you think about this week, when Russia started bombing Ukraine again, trying to disrupt the export ports and the grain facilities in Ukraine and the Black Sea. That has had a huge impact on commodity prices this week, particularly in wheat and corn, with soybean following along. Also, Russia's decision to pull out of the Black Sea agreement again impacts exports and imports, not only for those countries, but then it ripples through to the United States and impacts where our markets are going to be. So it's always important that we kind of keep up with what international policy is doing, have an idea of how that could impact exports. And of course, you always want to know what China's thinking, what they may do, but you cannot forget about Japan, South Korea, Taiwan, India, Saudi Arabia, Egypt, and Canada. All of those countries import ag products from the US, and their changes in policy can directly impact us. So this slide here is just kind of a snapshot of what exports have been the last couple of years, and then how they've changed since June into the July USDA WASDE report. So you can see in 2021, the crop that we grew in 2021 of wheat, we exported just under 800 million bushels. The crop that we're exporting today that we grew last year, we can see that exports are down about 35 million bushels, but they were roughly the same, okay? There weren't a whole lot of difference between 21 and 22 in the wheat exports. In June of this year, we expect to only be exporting about 725. So you can see in the last 2 years, we've dropped nearly 75 million bushels of exports. If we produce the same amount of wheat, that drop of 75 million just goes to our ending stocks. And as ending stocks increase, typically see prices decrease. But overall, there's not been a significant change in wheat exports at this point. But we need to keep an eye and just hope that we can hold on to that 725 export number for the crop that we just finished harvesting. In the US corn, you can see in 2021, we had one of the largest export years ever. Just under 2.5 billion bushels of corn were exported. Shift to this year, we had a smaller crop last year. We didn't have as much. The price was higher because of things like the Russian invasion of Ukraine, and we're projecting to only export 1.6. That's a drop of about 800,000 bushels. That's a third less than we did the year before. Currently, the USDA is projecting that we're going to get exports back up to 2.1 billion bushels, which is, an increase of 450 or about 500 million bushels of corn. Again, when we look at the supply and demand charts in a few minutes, you're going to see that if we don't get exports up there, we could still see really high carryovers in U.S. corn this year, even with some pressure on corn yields. In July, they held on to that 2.1 billion export forecast. Soybeans, similar situation to corn, had really good exports in 2021, just over 2.1 billion. They fell off last year to under 2 billion, but percentage-wise, it was not as big as the change in corn exports. In June, we were expecting to export about the same, but in July, you can see that those exports have fallen off about 125 million bushels. So again, all things being equal, a drop in exports is going to increase our ending stocks. Cotton is kind of unique here because we have to export most of our U.S. cotton production. And in 2021, we exported about 14.5 million bales, fell down to under 13 million in 2022. In June, we thought they would be back up around 14. And now in July, the USDA cut it back to under 14. This is really troubling because if we don't export it, it ends up on our ending stocks. Domestic use of cotton in the U.S. has been trending down for a number of years and currently is like 2 million bales a year. So its exports are critical for sustaining a good price for cotton. And right now, we're not getting enough exports to get that price up higher. So we've talked about these disruptors, and now what I want to do is to kind of show you some of the numbers and things that I'm looking at right now as we try to make pricing decisions for 2023. Again, on the left-hand side here is the corn supply and demand. The column that is in yellow is the crop year that we're currently producing, and that's the 23/24. We grow it in 23 and we market most of it in 24. These numbers were updated for the July WASDE report, which came out on July 12th. As I look at this, the left-hand side, the thing that really jumps out to me is this ending stocks. Most of the way down on the left-hand side, you can see that in 2022, we ended the year with about 1.4 billion bushels of corn. In 2023, we're projecting ending stocks of 2.2. Okay? If you look at the percent use, we were right at 10% of ending stocks of our projected use. In 2023, we're expecting that to increase to just under 16%. That means we have plenty of corn. Okay? That's going to make it difficult for corn prices to rally if we can hold on to our current yield projection of 177 bushels in the U.S. It's just hard to imagine corn prices going very high if yields stay in that range because we just have a lot of corn left over. When we look at seasonality of prices, we're shift over here to the right-hand side at that number 3 fundamentals. You can see that on average, since 2013, the average corn price in July has been $4.34. In August, it's been $4.20, September $4.16. Then in October, we see it start moving higher again. So what that says to me is that my pricing opportunities are kind of limited beyond July until we get on into October, November, and December, when we may see continued increases in prices. Going back to the interest rate situation, it would be very difficult to justify not pricing, and given that the trend is for prices to go lower, when we know that it's going to cost a lot of money to keep holding corn, and the price outlook for the next 3 or 4 months is worse than what we're looking at today. Again, that's on an average. That's not looking at day to day. Currently corn is up 30 cents today. And so I use these things to kind of give me incentive to take action. And so as I see prices rallying right now, you have to think about, are these good pricing opportunities for our producers in South Carolina? Other things I look at are, what's the highest price been in the last 100 days? What's the lowest? And we'll look at those on the chart. And then what's happening on our moving average. In the last 20 days, corn has dropped 63 cents. In the last 5 days, it's picked up 33. Okay. But you can see that we're still at lower prices on average than we were 100 days ago, and certainly year to date. Might be a little easier to see on the graph. This shows December corn since January 1st. This blue line represents the highest price in the last 100 days. And you can see that it was up around that 630, 635. It got lower and lower. And then back in June, when we had some weather scares, when those crop progress reports were coming out, in the Midwest, it looked very daunting, and many producers were scared of their yields. So we saw a really rapid rise in prices based off of that crop progress report. We went from 530 to 630 in less than a week. That remains the high, because then what we saw as we got into June 30 is USDA came out and increased the corn acres. I can't remember if it was 4 million or 2 million acres more than what they were projecting back in March. And so when we had a lot more acres, that took all of that price momentum out fairly rapidly. So within a week, 10 days, we had 2 big disruptors. We had crop conditions that looked terrible, and then we suddenly found a whole lot more corn planted than we expected, and it took us right back to $5.30. Since then, we've dropped lower. We've been under $5 for the early part of July, and currently we've seen a rally on some more concerns about crop conditions, and then primarily this Russian bombing of Ukraine earlier this week has spurred the market higher here. But again, what you want to kind of keep in mind is that our low has been in this 490 and our high has been in that 630. You want to start thinking about, where do I want to put opportunities to sell more corn? And again, I don't know if we can get back to 630, but where should you be looking to make some pricing opportunities? You can see we traded right around that 575 range for quite a few times back in April. That might be a place to look for some pricing opportunities if you still need to price some of 2023 corn. Looking at soybeans, you can see the same information. Again, what I like to look at is this ending stocks. It's usually one of the first things I look at. And you can see they're going to be the highest ending stocks in at least the last 3 or 4 years at 300. You can see our percent use is still much lower than it was on corn, but it's increasing. It's increasing. Our usage has gone from 4.5 billion bushels of soybeans, 4.5 to 4.3 to 4.3. So we're seeing some slight decline in usage. The soybean crop still looks like above average, or at least trend line yields across the US. So our yield still looks good here. Total supply is about the same as last year. It's just that we have a little less demand. and we're seeing ending stocks increase. It's causing quite a bit of price pressure. USDA is forecasting the U.S. cash price of $12.40, and futures for November soybeans closed at just under $14 yesterday. I think they're above $14 today. So it kind of makes you think, is this a pricing opportunity? We're nearly $1.50 higher than where USDA thinks the farm price is going to be. It may be an opportunity to start selling some beans and taking some of this price risk off. Again, we don't see much help from crop insurance this year. When we look at the fundamental and the seasonality of prices, again, July tends to be the high watermark on a monthly price basis. All the way through, it's at 1078. And then when you look at August, September, and October, from 2013 to 2022, they've stayed around that $10.57 price all 3 months for those 8-9 year period. So again, this says from a seasonality standpoint, this may be a good time to catch up on some soybean marketing. If we look at our moving averages, again, we can see we've been up for the last 5 days. We've been up for the last 20. We've actually been up for the last 50 days. Right? We're up $1.26 from where soybeans were 50 trading days ago. But year to date, we're about the same place as where we started the year. And so we're looking at the chart, and you can see exactly that. We started the year just under $14, bumped up there again late February, and then we just kind of trailed down till we got into May. And we made our low for the year on May 31st at $11.50. Since then, we've kind of spurred back up, got back up above $13.75, had some weather issues, crop concerns, and dropped back down to $12.75. And then when the acres report came out, we saw a limit up move. And then since then, we've been pretty steadily just seeing the soybean market keep climbing. So we're potentially making a new high for the year today. And again, don't get fooled. Make sure you have a plan to take advantage of some of these soybean pricing opportunities, because we're at the highest levels we've been all year. But this will be a good opportunity to sell soybeans. Now we're coming into cotton. We look at cotton and go to my first spot, which is ending stocks. You can see they've been growing. They've been above 3 million bales for the last 3 or 4 years. Currently, we're expecting them to be the highest ending stocks at 3.8, which will be slightly higher than our 2021 crop at 3.71. If we export 13.75 million bales and use domestically 2.2, we'll still have roughly 24% of the cotton we need for next year. So we have plenty of cotton in the United States. And therefore, we're seeing this cotton price just not be very supportive. USDA is forecasting a 76-cent price for cotton. Currently, the market is at 82 cents. But again, there's just not a lot of optimism on cotton, because even if we go back to our highest domestic use, it's only 300,000 more bales of cotton that we would use. If we could get exports back to 15, that would really be positive. But generally, exports don't increase when prices are high. So we're kind of in a pickle right now on cotton. Hope the pools are doing a better job marketing than I am right now. This has just been a tough market, particularly when you look at the chart. Since Mid-January, we've traded as high as 86. We've traded as low as about 77. But for the most part, we're just in this band here from 80 to 84 cents. There's just not been a lot of movement in the cotton price. However, to me, there's been a general decline in that price over time. I mean, we're drifting lower, not very fast, but we just seem to be drifting that cotton price lower as we go through this year. When we look at the fundamental prices, that same time period from 2013 to 2022, we can see that August has been about a penny higher on average than July. But then September and October have been lower than July. So hopefully in the next month, next 6 weeks, we'll have another little bump in cotton prices, and maybe people can catch up on their marketing for cotton if they need to. But again, it's just been a tough market to do much, because since January, our highest close has been right around 85 cents. But we've seen cotton well below 80 cents too. So keep an eye on that, look for your opportunities. Kind of have a goal, but if your goal is 90 cents, it's really hard when I look at this chart to think that we're going to get to 90 cents based on what we know today. So with that, I've kind of gone through those three crops, talked a little bit about the fundamentals and the pricing opportunities, and I'm going to wrap it up there, but I'll be glad to take any questions and try to answer them if I can. If you can just put them in the chat box, I'll be glad to read them out and give you my thoughts on any questions you may have. So are there any questions at this time? Okay, so we do have one person here who is buying corn, and that's he's a lot happier than I am, because I'm trying to help people sell corn. But he is not bothered that corn prices are going lower, because that's going to help his feed cost or whatever product he's making. Having lower corn prices can be a victory for some people. I'm glad you pointed that out. Does anybody else have any comments or questions? Somebody asked where we could go to keep up with these data updates. I put out a newsletter 2 or 3 times a month. If you would just shoot me an email to smickey, M-I-C-K-E-Y, @clemson.edu, I will add you to the newsletter and be glad to send you some of those updates. So my email address is on the screen right now if you need to write it down. Anything else? All right, well, I won't hold you until 11 o'clock, and I couldn't hold you if I wanted to. But again, thank you for joining the South Carolina and Clemson Extension Agribusiness team for the 3rd Wednesday of the month for our Disruptors series. We'll be back in August, and I do not have that speaker's information in front of me right now. We'll have another one on the 3rd Wednesday of August at 10 o'clock, and it should be on the same Zoom link. So again, I appreciate everybody joining in, and thank you for your questions. Have a great week.